Hello everyone, welcome to the 145th episode of me learning how to trade in Forex. So in the last episode we went through how CFDs differ from spread betting. Basically the differences between spread betting and CFDs is the deal size. When spread betting you bet amount of money per point of the market price movement. With CFDs you buy and sell contracts that represents a specified amount in the underlying market. And then we've got capital gains tax. Spread betting is free from capital gains tax as it's technically classified as gambling, I think. CFDs aren't, as they're classified as a financial instrument. So yeah, CFDs are classified as financial instruments, so they have capital gains tax on it. I don't know why I repeated myself saying that, but anyways, stamp duty on shares doesn't apply to either of these. So yeah, and then we've got expiry times. So spread bets tend to have a fixed time limit and will naturally expire if you don't close them. However, most CFDs will stay open indefinitely, except for futures and forwards. Don't know why that's not caps. Okay, so commission charges on shares. When placing spread bets, most providers' charges are included in the spreads. With CFDs, however, providers match the price of the underlying market and then charge an extra commission on top of that for carrying out the trade. So that's that. And now we're on to the quiz of that section, which I forgot the name of. So let's get started then. When you spread bet, you always make a fixed amount of profit if you're right about which way a price will move, or a fixed loss if you're wrong. False. Your profit can increase or decrease depending on how right or how wrong you are. On which of the following could you place a spread bet? The level of stock index such as Dow Jones, you can do that. Price of commodity, yep. Value of one currency, yep. The price of a company's shares. You can do it on all of them, can't you? What is spread betting? What is the spread in spread betting? The range of markets, the gap between the prices which you can buy or sell, that's that. When does daily funded bet expire and close? Daily funded bet at a distant future date. You open a spread bet selling retail group M for £10 per point at a bid offer spread of 818/820. By the time you later close the bet, the spread is 808/810. What is your profit or loss? So you sold it at 818 and then you bought it at 810. So you got a profit of 8 pips, not pips, 8 points. 8 points times 10 is 80. £80 profit. Which of these are true for both spread betting and CFD trading? Both. You can use leverage, you can offset losses against profits or tax. You can't do that. You never own the underlying asset. You can go long or short, yep. You'd stake an amount per point. No, that's only for spread betting. And this one, top one's only for CFD trading, I think. What are lots? The standardized contracts in which you trade CFDs, yep. Joe opens a CFD buying 2 contracts on the German DAX 40 index, contract size €25, and another CFD buying in 4 contracts on the French CAC 40 index, contract size €10. If each of these indices then falls by 3 points, what position gives Joe the greater loss? If each of these indices falls by 3 points, 2 contracts, that's 50, 4 contracts, that's 10. So 50 is more than 10, so German DAX. Which of these does not apply to CFDs? Does not apply to CFDs. Capital gains tax applies, stamp duty doesn't apply to CFD and spread betting. When might you receive a margin call? If you don't have enough money on account to fund your positions. Nice. So with spread betting, you generally win or lose more depending on the degree to which you're right. If the price moves the way you anticipate, then your profit will continue to grow the further it goes. However, if the market moves against you, your losses will increase as the price movement becomes greater. Which of the following could you place a spread bet? You can place a spread bet on all of these and a vast range of other financial assets and products, including interest rates, government bonds, and even house prices. You can also use CFDs to trade a similar array of markets. What is the spread in spread betting? When you spread bet on something, you'll see two numbers, a buy price and a sell price. The difference between these is the spread. A daily funded bet has a nominal expiry date at some distant point in the future, usually many years away, but you're free to close your position anytime before this, whenever the market is open for trading. So as you went short, a fall in the market benefited you. You sold at 818 to open a position and bought at 810 to close it. So the market moved 8 points in your favour. This is multiplied by a £10 stake. So there are many similarities between CFD and spread betting, which are both derivatives. However, they do operate in slightly different ways and their tax treatment differs. So CFDs are traded in standardized contracts, sometimes called lots. The sizes and denominations of these contracts differ depending on the asset, often mimicking how that asset is traded in the underlying markets. So although Joe bought fewer contracts on the DAX than on the CAC, the larger contract size means the overall loss is greater on the CFD. His DAX loss is 2 times 25 euros times by 3, which is 150. Why is it times by 3? Oh, 4 by 3 points. Oh, right, okay. His CAC loss is 4 times 10 times by 3 is 120. So which does these not apply to CFDs? Both spread betting and CFD trading are exempt from stamp duty. Capital gains tax applies to CFD trading but not to spread betting. Both types of positions can incur overnight funding charges, but you won't normally pay any commission for a spread bet as the charge is included in the spread itself. So when might you receive a margin call? You can usually open a spread betting or CFD account free of charge. However, you need to deposit money to cover the margin requirements if you want to start dealing. And you may need to top this up as the market moves. If the funds in your account drop below the level required to maintain your positions, your provider will ask you to deposit more money or risk having your position closed. Okay, nice. So, which one have we just done? I think how spread betting and CFD trading work is what we just went through. How CFDs differ from spread betting, yep, cool. So now we're on to choosing a market to spread bet on. Having covered the essentials of spread betting in our spread betting and CFDs course, it's time to take a closer look at the range of markets available to you and the mechanics of taking a position on them. For each asset type, we'll explain the important differences between spread betting and trading on the underlying markets. You'll learn about the special advantages spread betting offers as well as the risks involved. You'll also discover how providers price their markets, plus what determines their spreads. And by the end of the course, you should feel ready to choose a market that will suit you and the way you want to spread bet. Cool. Let's get started then. So, what do people spread bet on? So, what do people spread bet on? Date is the 24th. Right, okay. Most providers offer spread betting on shares, indices, Forex, commodities, ETFs and more. You can deal on just one of these or all of them. It's completely up to you. So most providers offer spread bets. Spread betting on shares, indices, Forex, commodities, ETFs and more. Shares. Shares are one of the most popular and well-known financial assets available. By buying a share, you buy a small part or unit of ownership of a company. By buying a share, you're essentially buying a small part or unit of ownership of a company. By buying a share, you're buying a small part of a company, meaning you also receive your own percentage of the company's profit in the form of dividends. So you should also receive your own percentage of the company's profits in the form of dividends. When you spread bet, you're betting on whether the price of these shares, which reflects the value of a company as a whole, will rise or fall. So, when spread betting shares, you're betting on whether the price of these shares, which reflects the value of the company as a whole, will rise or fall. As you don't own the share itself, you will not receive any dividends directly. However, your provider will make an adjustment to your bet to replicate the effect of any dividend payments as closely as possible. Your provider will make an adjustment to your bet to replicate the effects of any dividend payments as closely as possible. Okay. Stock indices. A stock index is generally... so that was shares. So shares. Stock indices. A stock index is essentially a number representing a group of shares from a particular exchange. A stock index is a number representing a group of shares from a particular exchange. Area, region, or sector. For example, the FTSE 100 is an index reflecting the value of the 100 largest companies listed on the London Stock Exchange. Each index is expressed as a figure based on the collective value of those shares. When you spread bet, you're betting on this number rising or falling. Each index is expressed as a figure based on the collective value of those shares. When spread betting stock indices, you're betting on this number rising or falling. Did you know the FTSE has only ever had one day off since it began, Friday 16th October 1987. Britain had been battered by the worst storm in 300 years, causing power outages and transport meltdowns across the southeast of England. This meant traders couldn't make it to work to open share prices on the London Stock Exchange trading system, and the benchmark index couldn't be calculated. Forex. Forex, short for foreign exchange, is how individuals and businesses convert one currency to another. It's the largest, most frequently traded market in the world, and it's always quoted in pairs, e.g. GBP USD, the British pound versus the US dollar, or the Euro/JPY, the Euro versus the Japanese yen. How individuals individuals convert, individuals and businesses convert one currency to another. Commodities. Commodities are natural resources like gold, oil, wheat and lumber. Natural resources. They're traded on dedicated exchanges around the world and their prices can vary dramatically because of supply and demand, the weather, natural disasters or geopolitical events. They're traded on dedicated exchanges around the world. Their prices can vary dramatically depending on supply, demand, weather, natural disasters or geopolitical events. Each commodity is priced uniquely, gold in dollars per troy ounces for example, or oil in dollars per barrel, but in each case you're simply betting on whether this value will rise or fall. So each commodity is priced uniquely and you're betting on whether this price will rise or fall. ETFs, exchange traded funds. Exchange traded funds are a way to track performance of a selection of related assets such as shares, commodities, bonds, currencies, etc. So exchange traded funds, a way to track the performance of a selection of related assets such as shares, commodities, bonds, currencies, etc. Traditionally they're traded on stock exchanges, but when you spread bet on them you're simply predicting their value will go up or down. Traditionally they're traded on stock exchanges when spread betting you're predicting if this value will go up or down. If you'd like to learn more about how all the underlying markets above work, you can go back to our Introducing the Financial Markets course. Otherwise, stay with this course as we go on to look at each key market individually and explain how spread betting works in relation to it. So let's in summary, you can spread bet on a range of financial assets or just stick to one. If you spread bet on shares, you're betting on whether the value of a company will rise or fall, and you won't receive dividends directly as you would in traditional trading. Spread betting on indices means betting on the collective value of a group of shares. You can also bet on the value of currencies or commodities and on baskets of related shares and ETFs. So next one, spread betting on shares. Spread betting on shares. Spread betting tends to be a more sensible, more accessible way to deal on shares compared to traditional trading, particularly in terms of the way you take a position and the costs involved. The mechanics of dealing. With traditional shares trading, you buy and sell the shares outright for a particular market price. When spread betting, however, you bet a certain amount of money per point of movement in the share price. So, traditional shares trading. Buy and sell the shares outright for a particular market price. Spread betting shares, so that's betting a certain amount of money per point of movement in the share price. A point tends to be the equivalent of a 1 unit change. 1 point is equal to a 1 unit change in the share price. For UK companies, that's normally a 0.01 exchange, 0.01 pound exchange. For US stocks, it's 0.01 dollars, and for many European shares, it's 0.01 euros. There are some exceptions, however, like Japanese stocks, where 1 point equals a 1 yen move. So it's always worth checking with your provider before placing any bets. So check with your provider how much is 1 point, how much is a 1 point move. Your deal will usually be in GBP unless you decide to change the currency, which means you can bet, for example, £5 on every 0.01 change in a US stock, or 0.01 dollar change in a US stock. This is very different from trading shares in the traditional way, where you would need to change pounds to dollars to buy those US shares, then convert dollars back to pounds when you sold them. For this reason, spread bettors who deal on international shares are generally less exposed to currency fluctuations than traditional share traders, and they can also potentially save on currency conversion fees. So, spread bettors who deal on international shares are generally less exposed to currency fluctuations than traditional shareholders. US stock XYZ is priced at 1850/1950. You decide to place a buy spread bet. Later on, the stock has risen to 2450, 2550. You decide to close a bet. How many points would profit be based on? So you'd buy spread bet at 1950, and then you sold it at 2450. So 2450 minus 1950, which is 5. No. Each point is 0.01, so that's $5. $5 is 500 points, because $5 is 500 times 0.01, so it's 500. For US stocks, a move of 1 cent represents a 1 point change, so in this case the price has moved a total of 500 cents from 1950 to 2450, which is the equivalent of a 500 points gain. If you had bet, say, £10 per points, this $5 rise would have given you £5,000 profit. However, bear in mind that if the price had instead dropped by just a few dollars, your loss would have been of a similar magnitude. The costs. In traditional trading, you generally go through a broker who buys or sells the shares on your behalf. Your broker will trade the shares at a current buy or sell price available in the underlying market, and then charge a commission based on the value of the shares. When spread betting, on the other hand, the cost of dealing is included in the spread. You can remind yourself how the spread works by going back over our spread betting and CFDs course. Providers will take the current buy and sell prices and add their own, usually percentage-based spread onto it, which is influenced by factors such as the liquidity of the market, its volatility, and the date the bet expires. Traditional shares trading generally go through a broker who buys or sells the shares on your behalf. Your broker will trade the shares at the current buy or sell price available in the underlying market, and then charge a commission based on the value of the shares. When spread betting, on the other hand, so what's it called? Spread betting shares. The cost of dealing is included in the spread. The cost of dealing is included in the spread. Providers take a current buy and sell prices. So providers will take the current buy and sell prices and add their own spreads onto it, which is influenced by factors. This spread is influenced by factors such as the liquidity of the market, its volatility, and the date the bet expires. Example, let's say A PLC, a major UK stock, is trading in the underlying market at a sell price of 201.5 pence and a buy price of 201.7 pence. Your spread betting provider might charge a dealing spread of 0.1% on the stock, so approximately 0.2 pence. Your provider will add half of this 0.2 pence spread to the buy price and deduct half from the sell price, giving you a final quoted price of 201.4 pence / 201.8 pence. Yep. Spread betting on shares is also free from stamp duty and capital gains tax. Remember, tax laws are subject to change and depend on individual circumstances. Tax law may differ in a jurisdiction other than the UK. So, spread betting shares is also free from capital gains tax and stamp duty. Going short. With spread betting, it's generally easier to go short on shares than it is via traditional trading. Again, because you're betting on the share prices rather than physically buying and selling the shares themselves. In spread betting, you can simply open a sell bet on your chosen market, which is just as straightforward as buying. To profit from a falling stock price in the traditional shares trading, you would have to commission a broker to borrow and then sell the shares on your behalf. You can find out more about that process in How Trading Works course. Leverage versus non-leverage. With spread betting, your outlay to take a position is much lower than it would be if you bought the shares in the traditional way. A spread bet uses leverage. Leverage means that when you place a bet equivalent to, say, buying say thousands of pounds of shares, you might only need to put up a deposit, also known as margin, of 5% or £50, rather than the full sum. You can find out more about leverage in the orders, execution and leverage course. However, it's important to remember that your potential loss is the same whether you trade in the underlying shares, or place a spread bet on them. In the example above, if the worst happens and the shares become completely worthless, your maximum possible loss is £1,000 in both cases. Remember that the potential loss is the same whether you trade the underlying shares or place a spread bet on them. So, lesson summary. When you spread bet on a share, you bet a certain amount of money on every point of movement in the price. This unit of change of share price can differ in certain currencies, so be sure to check with your provider first. Your deal will normally be in GBP, meaning you won't have to convert any profit or losses. When you spread bet, the cost of dealing is included as part of the spreads. Spread betting is free from capital gains tax and stamp duty. As you never actually own the shares, spread betting enables you to profit from falling markets as well as rising ones. Because spread betting is a leveraged product, you can put up a fraction of the total cost of the shares and gain the same exposure. So, spread betting is a leverage product. You can go short on spread betting shares. Cool. Spread betting on stock indices. As a stock index is essentially just a benchmark number representing a group of shares, you can't buy it or sell it directly on exchange known as the cash markets. So you can't buy a stock index directly on an exchange. You could of course trade each of the individual constituent stocks and their relative weightings, but this would be a complex and inefficient process. So the practical way to trade stock indices is via derivative futures contracts, bought through a bank or futures broker or other derivative products like spread betting. So a practical way to trade stock indices is via derivative futures contract. Bought through a banks or futures broker or other derivative products like spread betting. Or spread betting. From banks or futures broker or spread betting. Did you know derivative products are so called because they derive their value from an underlying asset such as a stock index? A derivative stock index futures contract is a basket of all the constituent stocks on an index and is traded on a regulated exchange. For example, the FTSE 100 futures trade on the Intercontinental Exchange. The prices at which you buy or sell the contracts are effectively the aggregated buying or selling prices for the underlying constituent shares. Every futures contract has an expiry date, and the value of the shares between today and the expiry date will change due to the effects of interest and any dividend payments. Taking into account these factors can cause futures prices to vary from the present value of the underlying index. So derivative products derive their value from the underlying asset. Spread betting providers create their own stock index markets with prices derived directly from the futures market for each underlying index. You'll notice that spread betting markets usually have different names to the underlying indices. This is because the actual stock indexes are calculated, owned, and trademarked by various organizations. For example, the Dow Jones Industrial Average is owned by S&P Dow Jones Indices, while the German DAX is operated by Deutsche Börse, so the names can't be used. Here's an example of a few of the market IG offers. Underlying index S&P 500, IG's market US 500, Nasdaq 100, Tech 500, Dow Jones, Wall Street, CAC 40, France 40, DAX 40, German 40, ASX 200, Australia 200, Nikkei 225, Japan 225, FTSE 100, FTSE 100. IG has a similar dispensation to use the FTSE 100 name. IG has a special dispensation to use the FTSE 100 name. Most other providers call this the UK 100 or similar. So spread betting providers create their own stock index markets with prices derived directly from the futures market for each underlying index. Spread betting markets usually have different names to the underlying indices. So spread betting prices, unlike shares, forex, and commodities, there is no direct buy or sell prices for the underlying stock index. There are no direct buy or sell prices for underlying stock indices. Each index has a unique value which is calculated on an ongoing basis. Your spread betting provider's buy and sell prices will generally be wrapped around this value, but being based on the futures market, they may not be aligned precisely with it. For example, say the Nasdaq 100 June futures market is at 4600 and your provider is offering a 2-point spread on its version of the market. This means you'll add a spread of 1 point either side of the current value to create a price of 4599/4601. The DAX 30 September futures market is currently trading at a value of 9398.5. Your provider is offering a 4-point spread on the market. What would its sell price be? That's 9398.5 minus 2 because it's half the 4-point spread, so that's 9396.5. 4-point spread means the buy price will be 2 points above the DAX's current market value, while the sell price would be 2 points below. Yep. Out of hours pricing, the value of an actual stock index doesn't change when the underlying market is closed. Okay, so the value of the actual stock index doesn't change when the underlying market is closed. For example, the London Stock Exchange is open from 8 a.m. to 4:30 p.m. UK time, from Monday to Friday, and outside of these times, the FTSE 100 doesn't move as none of its constituent stocks are being traded. Oh, right, I see. However, the underlying futures market is open longer. For example, the FTSE futures trade from the FTSE futures trade from 1 o'clock to 9 o'clock. So futures prices move with fluctuations in supply and demand while stock exchange is closed, and so do the spread betting prices derived from them. So spread betting prices move with fluctuations in supply and demand. However, the underlying futures market is open for longer. Of course, there are still periods when both the stock and futures market are closed, 4 hours in case of the FTSE. You may be surprised to learn that some spread betting providers are nevertheless able to offer prices for their clients on deal during these times. To deal on during these times. To do this, they use the performance of other markets around the world, generally other stock indices, to predict how that index should be priced. By applying a mathematical formula to these related markets, providers can derive a buy and sell price for the closed index. These prices also fluctuate based on the business that the provider receives while the underlying market is closed, as well as any news events that could influence the index concerned. It's important to remember that these out-of-hours prices can be very different to those that will be available when the market next opens. So although out-of-hours dealings enables you to capitalize on opportunities whilst markets are closed, there's also the risk of incurring a loss that would have been avoided if you had waited. In addition, since there's no market available to validate out-of-hours prices, you'll find that most providers offer wider spreads during these periods. This gives them a better chance of reflecting the underlying index level accurately in their trade pricing. Right, okay, so are longer so futures prices demand more and so do spread rates derived from them. Spread betting prices move with fluctuations in supply and demand. Of course, there's still periods when both the stock market close. Some spread betting providers are able to offer prices to deal on when both stock and futures markets are closed. To do this, they use the performance of other markets around the world. They use the performance of other markets around the world to do this. Generally other stock indices. Other markets. Generally other stock indices. To predict how that index should be priced. To predict how that index should be priced. By applying a mathematical formula to these related markets, providers can derive a buy-sell price. These prices also fluctuate based on the business that the provider receives while the underlying market is closed, as well as any news events that could influence the index concerned. these prices will also fluctuate based on business that the provider receives while the underlying market is closed, as well as any news events that could influence the index concerned. Yep. So it's important to remember that these out of hours prices can be very different to those that will be available when the market next opens. Remember that these out of hours prices can be very different to those that will be available when the market next opens. So although out of hours dealings enables you to capitalize on opportunities while the market's closed, there's also the risk of incurring a loss that would have been avoided if you had waited. In addition, since there's no market available to validate out of hours prices, you'll find that most providers offer wider spreads during these periods. Most providers also offer wider spreads during these periods, as there's no validation, as there's no price validation. This gives them a better chance of reflecting the underlying index value accurately in their pricing. So here are the typical spreads offered by IG at different times on the FTSE 100 daily funded bet market. So time 8 till 13 in hours, typical spread 1, 16:30 till 21 in hours, typical spread 2, 21 till 7, 5 spread, 7 to 8 in hours, 2 spread. And then we're back again at 8 to 16. Okay. So impact of leverage: when you spread bet on stock indices, you need to put up a margin payment which may only be a small portion of the value of your position. Remember that a potential loss could be much greater than this, however. Yep. So lesser summary: because indices are essentially just numbers that can't be bought or exchanged, you can't trade them in the traditional way. Spread betting providers enable you to speculate on indices by providing their own markets which shadow the underlying index value. Buy and sell prices for indices are created by wrapping a spread around the value of the index. Some providers offer spread betting on indices outside of market hours, generally with wider spreads at these times. So buy and sell prices for indices are created by wrapping a spread around the value of the index. Now let's move that to there. Oh wait, what was the last one again? Some providers offer spread betting on indices outside of the market hours, generally with wider spreads at these times. Yep. In the next video, we're gonna carry on with choosing a market to spread bet on with lesson 4, so spread betting on Forex. So thank you all for watching, and I will see you guys in the next video. Bye bye.